Welcome back, everybody, to the Lowdown. I'm Michael Smith, and joining me today is Bradley Olson with Recurrent. Brad, welcome to the show. How are you?
Mike, thanks for having me. It's a great day to be here.
It is a great day, and for many of those who don't understand what that means, why don't you tell us about what you do, and now that'll answer that probably pretty quickly.
Yeah, sure. We're Recurrent Investment Advisors. We're a Houston-based energy manager, and over the weekend, President Trump ordered the U.S. military to strike targets in Iran, which means that oil's on the front page again.
Well, that being said, I think everyone's question, over the weekend, I think everybody, certainly if you were even anywhere near a TV, you know what happens. I think for many of us, we also realize this isn't a kind of a one and done, as we saw, in the last strike with Iran. This has a lot more impact. It has a lot more breadth, and obviously there's some retaliation. But great first question. Why don't you talk to us a little bit about what this means for the oil markets and in terms of what you guys do as well?
Well, last year we wrote that the United States shale patch is capable of basically keeping the oil price between 55 and 85 in the face of almost any disruption. When we said that, a lot of people said, no way, the U.S., people can't rely on the U.S. anymore. People don't want to trust the U.S. with their energy security. And the reality is here we've got, the Ayatollah of Iran dead in an airstrike, and we've got oil price up significantly this morning, but up $5 on a world-shaking event, which I think kind of comes back to the U.S. is the increasing source of energy security to the world at large.
Well, you're absolutely right about that price movement. You go back 10 years ago, Brad, we would see almost a disastrous day of oil in terms of price swings, right? And then, of course, anything people, they got to cover shorts or cover whatever they'd have to do, but that's not the case. But you talk about the U.S., resilience in terms of the oil. Can you maybe just go into depth, explain that for everybody listening? How does now the U.S. player keep that price stable the way you were talking about?
Yeah, well, for most people who think about, the oil market of the past in the 70s, 80s, and 90s, the oil market was defined by mega projects, Alaska, Siberia, Mexico, big offshore projects that took 10 years to come online.
Auger and Mars, those big ones. Yeah,
exactly.
Yeah.
10 years to come online and took 20 to 30 years to peter out. So if you were oversupplied, oil price would stay low for years. If you were undersupplied, oil price could stay high for years. The argument we made in our research is that the United States shale patch is uniquely capable of adding 1 million or more barrels a day within 12 months, which is something that no other resource on Earth can match the how quick that dispatch is.
That's definitely something that you haven't seen. Again, back to you're talking about big projects. It would take 5 years for that production to get online. So if you had that demand shift in the middle of that, then that's why you saw the price swing. But what you're saying is the shale oil, the ability for the U.S. to extract it fast, get it online, is what leads to this price stability that we're seeing, or at least staying in this range that you're talking about, correct?
That's right. So at $55, last year, as often is the case around a bottom in oil, we heard from a lot of folks who aren't based in Texas, hey, oil's heading to 30. I don't know if you guys see the economic data. Oil price is just going to get weaker. And our argument was, the United States onshore producer is not really making a cash margin at 55. He's not even covering his drilling cost. And when that happens, you're close to a fundamental bottom. And, when oil gets to 85, or above, when Russia, Ukraine, great example of that, you see an almost instantaneous response where drilling activity really ticks up in a meaningful way. And so the argument we've made is that at 55, it's much too late to be bearish. And that's what we told our clients at the end of last year, time to get positioned for the next upswing when you're at 55. And at 85, you should expect that the U.S. is going to add production to ease the market at that point. And so, we've kind of explained, and our investment strategy has been based around this idea that it's a lot easier to bet on increasing energy supply to the world coming out of the United States. We're becoming a bigger global supplier, and that's really been a one-way trend.
Yeah.
Oil price continues to bounce around in that 55 to 85 range.
Well, I mean, this is definitely something I don't think many people are hearing, which is why I'm glad you're here. But even if for those that right now, the headlines are probably not going to be very convincing that oil can kind of withstay in a range. I mean, I think right now what you're going to hear about, and maybe something you could talk to, how much global GDP or global demand really is Iran in terms of how much comes off with this whole incident. And then also maybe if you could talk about the Strait of Hormuz, which is another one that's on the news right now. They're talking about potentially shutting that down. That could be devastating for oil markets. These are the headlines. Break down the myth or the narratives here.
Yeah, well, I think the reality, like all markets, the oil market is always going to take the last war and apply it to whatever's going on here. And I think there's a lot of folks who say the U.S. supply has been so resilient, so responsive. The U.S. has kind of put a safety blanket around the oil market now for over a decade. And we've seen a lot of, Libya, Saudi Arabia, Iran last summer. We've seen a lot of disruptions that ended up being not as bad as feared, maybe. And so today, I think you've got a huge amount of complacency that things in Iran will somehow kind of muddle through without huge disruptions. And you also have this belief that the U.S. is going to make up for any dislocation. And so I think the reality is today we've got a hugely complacent oil market. Mm-hmm. It's complacent for a reason. I mean, the U.S. has been very reliable as a supplier, but I think the ultimate kind of 5-10 year playbook has to involve some scenario where, hey, one of these geopolitical disruptions could become major. Yeah. And meanwhile, the United States has been supplying the world increasingly for the last decade, but the U.S. has been supplying the world by burning through a lot of its best inventory. So at some point, inventory quality in the U.S. begins to degrade and the world becomes a more and more dangerous place. You are, I would say, over the next 5 years, you're looking at an asymmetric skew to the upside for energy prices in light of those two factors. But I think the reality is on any given crisis, it's just very hard to say that this is going to be the one, this is going to be the play that breaks all the way to the end zone. That's just a hard call to make.
Well, you said that, the market prices the last war was quick and swift, right? I mean, that was in, was out. I mean, so there may be some risk of this prolongment or this continuation, right? If that does somehow, damage supplies or keep supplies constrained. So that could be one risk there, but it even sounds like, and I think that a lot of people got to get, that they have the past. We all here, especially in Houston, remember the boom and bust cycles. You and I were talking offline and kind of what you're bringing on. It sounds like these boom and bust cycles are going to be somewhat, less frequent. They're going to be smoother. We may see inter-term volatility quickly, but the big, long boom and bust that basically towns went bankrupt, we're not seeing that type of oil market. And this is probably not going to be a precursor to that as well.
Yeah, I think what we've seen is just the moderation of that boom-bust cycle. We've got a much more adaptive supply environment. Shale is able to adapt to a lot of different things in 3 to 9 months, which is something we've just never seen before. And I think when you look at what happened this weekend, Strait of Hormuz partially closed. All Qatar LNG exports to Europe have been suspended. European gas prices are more than doubled over the last 24 hours. It's a market where supply coming from the U.S. is looking better and better in light of how dangerous the rest of the world is. And so when we look out, we kind of say it's much easier today to look ahead in the energy market and see just structural growth in U.S. energy exports of all kinds, refined products, motor fuel, LNG, propane. We're exporting all these things structurally more and more, and that's stabilizing global energy cycles, making them less volatile, less violent. And so, when we look at it, we say one of the easiest bets to make as an energy investor is not trying to predict price 12 months from now, but just betting on the fact that the U.S. importance as a supplier to the world is just structurally increasing going forward.
Well, I think that's something that most people will come around to trying to understand. But what I'm hearing also is that the geopolitical driver of oil right now is probably what everyone thinks is happening, but you're kind of bringing back the fundamentals. And if I'm hearing you correctly, you're basically saying trust the fundamentals. They should keep this in order. Is that correct, or what do you think on that?
I think that's right. I mean, I think we look at we look at the globe today and we say, over the winter we touched that $55 fundamental floor. We're still a long ways away from that kind of $85 fundamental ceiling. So we're in an area where we do think there's potential upside to oil price. But ultimately, when we think about structurally, one of the reasons we like, midstream refining, these are all areas that are really benefiting from the growth of supply out of the U.S. Whether price is 50 or whether it's 80, these are all areas that are going to continue to experience growth. And we'd much rather kind of bet on a sure thing like that kind of growth than bet on, the incremental move in oil price or gas price.
So typically the go-to was geopolitical, war, anything. That's going to be bad for oil, could be shocking. Traders are running crazy. People say, get out of oil, et cetera, right? What I'm hearing is now, look, the U.S., resiliency in terms of being that producer, that swing producer, being able to come in should smoothen out any, let's call it, hopefully, this is pretty major, but any major geopolitical event, we should be able to rely on the U.S. really being able to kind of, buffing that blow, so to speak.
Yeah, I think, the headline kind of writes itself. The Ayatollah's dead and oil prices in the 60s, right? Any other time in history, those two sentences would never go with one another, right? And so that, I think, is the biggest thing, that the world we're describing, a world of less boom and bust, more structural growth for energy, that world is already here, even though the headlines don't seem to, the headlines don't reflect it, but that world's here. We're in a world where major oil producing governments can be overthrown and oil price is still somewhat tethered to where it's been for the last 12 months.
So if you're holding energy, what would be your words of wisdom right now? Probably not to go and panic and do anything, let things kind of shake out. What would be your
as
advice?
A portfolio manager, I always say, you don't want to be doing anything on a highly emotional, volatile day, right? When we look back and we look at Russia, Ukraine, we look at the Iran bombing campaign from last summer, there were a lot of opportunities both before and after those events. You didn't necessarily need to do, if you sold everything when Russia invaded Ukraine, you missed out. Like we're fond of telling people who say, well, you're just an energy oil fund. Like the fund's up 60% since Russia, Ukraine, because we focused on these themes that have really persisted. And so, you shouldn't be just reacting to headlines. You should be looking for opportunities and themes that are going to continue regardless of whether it's a limit up day in oil or a limit down day in oil.
Well, not to forget, but another big geopolitical event was Venezuela. How are you seeing any of that? Have you seen any of that shake out? Have you seen any improvement? What is that looking like in terms of the oil economy as well?
One of the things we talked a lot about with Venezuela is, you look at the U.S. refining complex on the Gulf Coast and you say there are going to be a lot of companies who are duking it out to get a toehold in Venezuela. Maybe the government changes. Maybe the government respects or doesn't respect contracts. Maybe it's a dangerous place to operate. You could just sit on the Texas or Louisiana side of the Gulf Coast and wait for those Venezuelan barrels to float their way over to you, right? And I think that's kind of been our argument. We're fond of saying you don't want to always try to solve the hardest question in the market. You want to solve the easy questions. And to us, there are going to be a bunch of U.S. assets which can make use of Venezuela crude if it comes our way. Mm-hmm. And you can invest in those assets rather than trying to figure out who's going to be the first guy to win a contract from a Venezuelan government that maybe has changed its stripes, but maybe hasn't changed its stripes.
Okay, no, definitely a good answer. Like I said, and geopolitics seems to be kind of the rule, but you guys do a lot of it. And I want to point out your firm, you and your team. You write a lot of great research. You really break down the stuff. I would urge anyone that's continue to have oil and gas in their portfolios to read your research or white papers, because you break down a lot of myths, and that's another reason. I didn't time it this perfect, but this is the reason I wanted you to come on today. But also let's talk about AI and how we just talked about the U.S. being that swing producer can really help smooth that price action. How is AI playing into this, and where are you guys seeing that?
Yeah, well, I think one of the, energy's always been viewed as this kind of wild, volatile sector. It's impossible to underwrite anything. And one of the big things that we've focused on is AI as well as LNG are two sources of future demand, which are actually going to be, stabilizing forces in the oil and gas markets. Historically, the vast majority of gas price volatility has been the result of cold weather in North America or in Europe. When the weather forecast drops 20 degrees, gas prices shoot up because it's really sensitive to price and how much fuel we burn. Well, looking forward, AI and LNG, those are going to be things which, use less gas when it's cold. Hey, gas price just tripled from $3 to $10. Well, LNG exports are going to ratchet down. AI demand's going to ratchet down, going to shift over to nuclear demand or, solar demand. So I think when we look out, we kind of tell folks like energy's never going to be like the utility sector. It's never going to be regulated and sleepy. But we are entering into a world where U.S. supply is kind of become much more economically driven and much more stabilizing in the world. And now we're going to move to an AI and LNG dominated market where there's a lot of economic sensitivity to that demand. You're not going to see everything just weather driven. It's going to be a market where the economics of supply and the economics of demand might keep us in tighter price ranges for longer, which, as an energy investor, I say, that's great.
Bring it. Well, you're saying energy is getting boring, but you're probably like, you know what? We welcome boring. Right?
Yeah, that's right. Enough excitement, to fill a lifetime in the last 15 years. And so,
yes. I mean, I've seen those swings and the price swings. I mean, being in Houston, a lot of clients, have a majority of their portfolios in their company stock. And certainly they've seen the swings to where like, oh no, or if it ever gets back here, I promise I'll sell, So seeing that buffered out, obviously you talked about AI really helping with that. Where do you see and how would you communicate as far as what you guys do, your products? You have several funds if you want to mention those. And then where do those typically kind of fit in for somebody that's managing a portfolio in that energy space? Where does that fit into their portfolio?
Yeah, so the main product we manage is the Recurrent MLP and Infrastructure Mutual Fund. And we've got separate accounts in natural resources as well.
Okay.
But, the primary mutual fund vehicle, the way we describe it is, this is an industry where if you can plan for the long term, we think your investment outcomes are better. And so, believe it or not, the XLE, the big kind of index fund that holds Exxon, Chevron, Oxy, all the big guys, the average reservoir life of a lot of those companies is less than 10 years.
Okay.
So if you've got less than 10 years of drilling locations, you've got to be out there acquiring, drilling. You need to always be thinking about how to replenish your cover.
Always on the move.
Always on the move, regardless of what's going on with price, ESG, all these other factors. So our view is, if we can have a portfolio that's primarily pipelines, maybe some refining assets, maybe some long-dated royalty assets, if we can build a portfolio that's got a 30 or 40-year lifespan, we can be thoughtful. Hey, the world is moving towards ESG. Well, none of our assets are going to peter out in the next 5 years. So we're not bothered by that. Hey, the oil price is rallying and if you want to hire a new drilling crew, you got to pay 3 times more for a new drilling rig. All right, well, fine. We've got a 40-year asset with a long-term planning outlook.
Yeah.
You don't have to go hire a crew to fix a pipeline when inflation is raging and oil price is 100. So by owning these longer dated assets than what you find in a lot of the index funds, we feel like we're able to plan a little bit more thoughtfully around the ups and downs of the commodity market.
So more like a good growth and income type strategy basically for your portfolio.
The portfolio, despite COVID and all the insanity that we've seen, Russia, Ukraine, it's been about a 13% compound return since we launched it in 2017. And about half of that has come as income. So, it's been a pretty even income appreciation split. And obviously since COVID, it's been more of a, 20% plus type total return. But even including, the drawdown and the volatility of COVID, it's still, if you looked at just the inception to date performance, you'd say, well, this looks like just a calm, income plus growth fund. And obviously there's been volatility during that period, but you're exactly right. We want energy to be thought of not as a crazy hedge or one like black swan, Taleb type investment.
Exactly.
We want people to think about this as, hey, you know what? This might be better than my REIT or better than my utility exposure because it gives me a little bit more inflation protection.
Or it can enhance either one of those.
Yep, and it gives me income that's going to trade somewhat opposite my fixed income portfolio because it's got a little bit more of a hedge against inflation and higher rates.
Well, it's a great diversifier, and one, I just want to tell you, definitely thanks for coming on. It's a great opportunistic time to talk about a lot of geopolitical things, but I think what you're saying today is really breaking down where people really need to be thinking about energy. Stop with the noise right now. There's going to be plenty of it. And you guys are great operators, but you're educators first, and I appreciate that. And I'll leave how to get a hold of you and your firm and your funds. All that will be in the comments here. So anyways, thanks for coming on, Brad.
Thanks, Michael.
You're welcome.